Welcome to Thoughts on the Market. I'm Marina Zavalok, Morgan Stanley's Chief European Equity Strategist. Along with my colleagues bringing you a variety of perspectives, today I'll discuss why our mid-year outlook extends our bullish view on European equities. It's Tuesday, May 28th at 10 a.m. in London. We've recently updated our outlook for the year ahead, maintaining our bullish view on European equities as we fully incorporate and roll forward our mid-1990s soft landing playbook. Like today, the mid-1990s was a period where markets focused on rates, inflation, and related data above anything else. The US and Europe saw soft and softish landings. The Fed's cutting cycle was slower than investors initially expected. And there was an undercurrent of technological innovation. European equities in particular are following the mid-1990s path closely, and that means both a mid-cycle extension and a strong market setup. We have high conviction in our constructive European equities view, and have recently raised our one-year forward MSCI Europe index target to 2,500, 18% potential upside. This brings potential total return upside if we incorporate dividends and buybacks to 23%. So why do we remain bullish? Over the second half of this year in particular, we anticipate European equities' ongoing re-rating is likely to combine with an emerging European equities earnings recovery. We've just come out of one of the strongest earnings seasons Europe has had in several quarters, and we anticipate this is only the beginning. Our earnings model projects 7.5% earnings growth by year-end for MSCI Europe, which is almost double consensus estimates. On top of this, we think the market underappreciates a number of significant thematic tailwinds that benefit European equities. These include rising corporate confidence, an M&A cycle recovery that is leading the global trend, an imminent start to rate cuts, high and rising capital distributions, including buybacks, and underappreciated AI diffusion. In terms of our sector preferences, structurally, we continue to prefer Europe's quality growth sectors. These include software, aerospace and defense, pharma, and semiconductors, along with the bank sector. Shorter term, we also believe a recovery in bond yield-sensitive stocks has begun, which is expected at this stage in our mid-1990s playbook. We expect this rally to be tactical and bumpy, but ultimately more powerful than a similar rotation that occurred around the Fed pivot late last year. We recently upgraded building and construction to overweight to play this rotation. Although we believe European equities are in the sweet spot over the second half of 2024, we expect the bar for continued performance to become tougher by the time we get into the first half of 2025. Also, our bear case incorporates rising geopolitical risks and lower than expected economic growth. The latter is in line with our economist bear case. A U.S. election scenario that would bring a change in the status quo is also a risk for European equities, albeit it's far more idiosyncratic than broad-based, according to our in-depth analysis. Thanks for listening. If you enjoy the show, please leave us a review wherever you listen, and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.